What does this capital gains increase mean to you? Let's start with what a capital gain is. It's an increase on an investment of a certain type. Could be property, could be stocks. You get the idea. Now, capital gains tax rate has been at a certain rate on 50% of the gain. What's happening is they're increasing it to 2/3 of the gain once you achieve a threshold of $250,000 in gain. In other words, the tax on that amount of gain is going up by 33%. That doesn't sound like a big deal in many cases, but if you've had something invested for a long time, like a stock portfolio or a cottage or what have you that's gone up in value, there might be a very large increase there. And so you're seeing a bit of a rush right now for people to dispose of those assets if they're inclined to before they're going to have to pay the additional capital gains. But what's probably of more import is, you've heard me talk many times about how tax increases are coming. And they're not all going to come in the form that we normally expect, which is, hey, your marginal tax rate's going up. The amount you pay on your income is going up. It comes in the form of many, many different taxes all over the spectrum. And this is a big one. And if they've come for this, which is a fairly sacred cow, you can anticipate that they're thinking hard about how they could come for a capital gains that you get on your personal residence. They started forcing you to report the capital gains on your personal residence back in 2016. Not because they want to tax it, but just because. So generally speaking, when government starts tracking something like that, you can rest assured that taxes are coming at some point. And I think you'll see that they will. It'll probably start at a capital gain increase over a certain amount, and then those categories will get worked over. Why this matters to you is because you want to be building your plans in such a way that in the future, when taxes are going to be significantly higher, you have protected yourself from those tax increases. There's a number of ways to do that. We talk about it all the time. The most obvious one is tax-free savings account, but it's not very big. Then you get other things like your personal residence, a good store of value, and cash value life insurance is another one. There are a few others. Personal small business, like small businesses, incorporated small businesses. Unincorporated as well, but generally we do these as incorporated. So you really need to be planning for how you're going to either pay a whole bunch more tax in retirement than you're thinking you will right now, or how you are going to manage your affairs in such a way that you can limit the amount of tax you're going to pay in that future.